This episode is brought to you by Fiscal.AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. Got a very important episode today. I'm joined once again by my friend and business partner, Max Weethy. Max, good to see you.
Good to see you too, Jack.
Max, earnings season is upon us. I want to get into JP Morgan's earnings number, which was very interesting. But first, we got to start out talking about some significant policy announcements from the US executive branch that are already moving markets in a big way. Venezuela has already happened. The market impact was somewhat muted, but there are very important things going on right now with regards to credit card interest rates, with regards to mortgages and particularly mortgage-backed securities, defense stocks, and several other things. So, Max, let's start with interest rates. President Trump announced on Truth Social that he was planning to cap interest rates at 10%, which is well below the level that they are at for many Americans. And this caused a sell-off in bank stocks, which are dependent on credit cards for actually a great deal of their profits, in particular the payment giants Visa and MasterCard, which make money not directly from interest, but they make money from the volumes. And when interest rates are high and banks are making money, surprise, surprise, credit card volumes are very, very high. This matters a lot, Max, because a great deal of profits comes from the bank share. Banks, in terms of volumes, mortgages, they do a lot of mortgages, they do a lot of commercial loans. Obviously, they do a lot of investment banking. But I think people, if they looked at where the actual profits come from, credit cards is very profitable. Surprise, surprise, making loans at 20% or 28% APRs, it tends to be a good business, even if it is an unsecured loan and the charge-off rate can be 3% normally, or in a recession as high as 10% or maybe even higher. So first off, Max, I want to note that I think if I don't think that this is going to happen. Um, but I think that the market is currently toying with the possibility that this actually is going to happen. I think that, let's just assume that it does happen, Max. I think that the companies that make the credit card loans with the higher APRs are going to feel the heat the most. So that would be companies like Capital One, which focus on the middle market, more subprime consumers. Companies like Synchrony, which many people don't think, oh, I have a Synchrony card, but actually they probably do because they're big in partnership. So probably when I go to my Dwayne Reed owned by Walgreens, and they have some, oh, would you like to join our credit card, sir? That may as well be Synchrony. I don't know, but they're in that business. And so those APRs are at 25 and 28%. And whereas JP Morgan, they also make APR loans. They reported today that their net yield on their credit cards is roughly 10%, but that takes into account deposit costs. So they're probably they're a lot higher. And if you actually look at your credit card statement, it is materially higher than 10%. I think American Express, who targets the more prime customer, wealthier folks, they might not be as affected by this cap. Uh, the Bloomberg article today was saying how JP Morgan was announcing that it's going to do everything it can to fight this, and that is part of the reason why I think it's probably not going to be enacted. But actually, Max, just before we started recording, there was another Bloomberg article, and it cited that actually the some credit card companies are toying with the idea of trying to appease the president by putting out a teaser card, like launching a credit card that has a 10% cap, but not changing any of their other business.
Or not giving it to anyone, right? Like you can put the card on the market and deny a lot of people the 10% cap. I think it is pretty obviously a political stunt, kind of running. I mean, we're here in New York, kind of running the Mamdani playbook of running on affordability issues. As James Carville once said, it's the economy, stupid, and we're in this K-shaped economy where I'm sure the people who are actually feeling the pain of these super, super high interest rates on their credit cards are the people most concerned about the state of the economy. And so, Trump, this is his last term. This is his last midterms. So in November, we are going to vote, and he would like to maintain control of the legislative branch so that they can make appointments, they can pass legislation, and he can solidify his legacy. So I just think it's the type of thing that he gets to trot out now, talk about. It can get all slogged up in Congress, not actually happen, but he can say, "I brought this forward," and then if they win, then the Republicans don't actually have to pass it or mess around with it because they already won. And if the Democrats win, then they won't pass it because it's a Trump bill and it won't happen. So, I am with you that I do not believe it is going to happen. And, I certainly don't think it could be done by executive order.
Yes, and I want to be clear that when Max and I say that we don't think it's going to happen, we do not think that there is going to be a law capping interest rates at 10% on credit cards that will actually be effectual. JP Morgan and Bank of America could announce the Trump card that has very low uptake, that has a 10% cap, and that will allow the president to declare victory. But I don't think that come Q2 or Q3, when Bank of America and JP Morgan report, that it will lead to a material decrease in actual credit card fees paid. So I just want to be clear, when Max and I make a prediction, what the prediction actually is, so we can see if we're right or wrong. Also, from a Bloomberg article, there's a quote that Trump's demand to cap rates was not backed up by legislation, and he provided no explanation for how the lenders would be breaking the law. So the president did declare that if by January 20th, so in only a handful of days, Max, the cap interest rates on credit cards are not capped at 10%, that the president those companies will be in violation of the law. But unclear what that law is. We will see. Max, there was another post by Truth Social, on Tuesday, January 13th, that actually did surprise me today, because I saw on January 13th Visa and MasterCard selling off, businesses that are famous for being extremely high quality, of extremely high profit margins, very high returns to shareholders, very high growth for a business that you might not associate with growth, credit cards. And those stocks were selling off today, and it was deemed to me by to be a buying opportunity, in my own personal opinion. But then I wasn't aware of this second post that the president made, and this was in support of Roger Marshall's Credit Card Competition Act. Roger Marshall, a Republican in Congress, and also from the Democrat Dick Durbin. And this act basically requires at least one of it requires two companies to be available to when people go into a store, and one of them has to be a company that's not Visa or MasterCard. So Visa and MasterCard do have a very large share of the card market. The only two competitors of any note would be American Express, which is its own network, and then Discover, which was recently acquired by Capital One, a bank. And American Express is a closed network, meaning that American Express is the bank, American Express is the network, whereas Visa and MasterCard are networks on which banks can issue cards themselves. So I want to say that the Credit Card Competition Act has been bandied about within Congress for a while, and I think with very little upkeep, perhaps because of lobbying efforts and the like. I think, Max, if this act was passed, I don't think it would have super negative consequences, and I think that there might be some temporary relief for small business owners. I mean, I think if you go to a store and buy something, particularly for the non-Walmarts, the small businesses, the small bodegas in New York, for example, that they the interchange fees that are collected by Visa and MasterCard, but the lion's share of which mostly goes to the banks, are in the neighborhood of 2%, 3%, or 4%. So if you have a gross margin of 5% and the payments company is taking 3%, over half of your profit margin is being taken by these fees. So I've never been in the position of running a retail chain, or working in one, but I do understand the pain, and the frustration there. And I actually did watch
So how would requiring them to have multiple networks not have a consequence for them?
For the banks, for the payment processes, or
For the
for
small businesses, that's I guess to me it seems like it would be incredibly negative for small businesses to have more networks, right? Like they have the ability, like you've probably been to a small business where they say, I will not accept an American Express. I don't want to pay the fees that network requires for me to be able to do that. So they have the ability to take MasterCard, Visa, Discover, American Express. So I don't see why requiring them to have more would be better for them when they have the ability to take them on.
sorry, I misspoke a little bit. The proposed legislation actually requires credit cards to have two networks on them, one of which is not Visa or Mastercard. So right now, all these big banks are partnering with Visa, or they are partnering with Mastercard, and some of them are partnering with Discover. Although actually, I don't know about that. But right now, it would force them to be on a network that's not Visa and Mastercard. So the idea is that it would improve competition, and that the banks might not like it, but that it actually would be good for the merchants. And I think it probably would be good for the merchants. And to be clear, to be honest, I am an investor in Visa and Mastercard, and but I think that if this legislation was passed, um, it could hurt Visa and Mastercard, but it probably would be a net positive for retailers.
Well,
Uh,
certainly it is being passed on to consumers, like whether it's being done in the sticker price of things or at the point of sale. I mean, I am increasingly seeing at a rate that is beyond just like, oh, 1 out of 10 businesses are passing on the fee. I would say that I'm seeing almost 50% of the businesses that I'm going to are offering a cash discount.
so I think, Max, that Visa and MasterCard have extremely high profit margins, but the simple fact is that these very high swipe fees of 2%, 3%, even 4%, most of that, vast majority of that, does not go to Visa and MasterCard. It goes to the banks. And what do the banks do with that money? Some of that is profit, yes. Some of it goes on to operating expenses. A lot of it goes onto rewards to attract people to be on their network. So all of the American Express points, the Chase Sapphire lounges, which are let's those lounges in the airports, I think, are so overrated. I mean, I'd rather just like sit and chew my gum. So the reality is, Max, that some people may say earlier in my comments about how I think there are going to be negative consequences on this 10% cap, and why I don't think it's going to happen. The reality is, we do live in a very K-shaped economy, and if you look at the credit card business, you have some parts of the country who use their credit cards who are somewhat low income, slightly lower financial sophistication, and they are revolvers, people who are actually in debt to the credit card companies, and they pay uh, they pay that interest every single a month, or it stacks up, and that is how the credit card companies make their money, in addition to the interchange fees. And then there's a cohort of customers who probably higher income, higher wealth, maybe slightly higher financial sophistication, or just they have enough money to do it. Who pay off their balance every single month, and they are the beneficiaries of these rewards networks, and they get their free plane tickets, they get their hotel book, the things that make them feel
You're
important.
paying for that every day though. They've done studies like rewards are not nearly as big in Europe, and that the average price for things, adjusting for cost of living, like that we pay higher prices here because of this. Like everything you buy, like yes, you got your free plane ticket, but you paid for it with every sweet green salad that you bought, with every bottle of milk that you go and buy at the supermarket. Everything you transact with, it pays for that over time. So we all
But
pay.
the vast majority, Max, of a lot of the profit comes from, a lot of it is paid by the debtors, people who actually are borrowing on their credit cards, not by the swipers, the people who pay only via the interchange fee, which is not a real cost to them. I also think,
I'm
Max, you
talking
said
about sticker price. Like it's not that it's coming out of the interchange. It's that it's It's not necessarily coming out of the interchange. Like I'm saying, like that
Oh,
4.
it's the annual fee. It's the annual fee, you
No,
mean?
no, the sticker, like something that would be $10 in a world where we don't have all of this rewards gimmicks happening is $11 here. You're paying $1 more. The cost of the good that we are buying is more expensive because of these rewards. You're not getting free money. There's no free money.
I actually think it is somewhat free money. I do think, Max, people who are not revolvers, people who pay their credit card every time, they are a net beneficiaries of this system. Yeah, I I I I I think they are. I think their rewards are something.
For the really smart people who are constantly switching and playing the games and they're always getting more points, but if you're just doing like the standard points, you're not getting out ahead. It feels nice and it makes you spend more because you feel like you're getting money back, and it increases the volumes, which is what makes the whole thing happen. That makes the whole American consumer economy work. It's good, but it's not real. It's a mirage.
You're going even further and saying that the point beneficiaries don't even benefit. All I'm saying is that the people who are paying massively and who, whose resources are being drained are people who revolve every single month. That, I want to stick with what's inarguable. You referenced Europe. Interchange fees are capped in Europe. They are not capped in America on credit cards. They are capped in Europe. As a result, credit card rewards are far lower in Europe. So they have a different system. I earlier said Dick Durbin, who is a Democrat, is a co-sponsor of this bill that President Trump is now in favor of. Dick Durbin is famed for the Durbin Amendment within Dodd-Frank, which is it caps interchange fees on debit cards. So debit over the past 15 years, there has been a seismic shift in the composition of payment. Obviously, cash as a percentage is going down. That's in a secular decline. But in particular, debit cards have gone down and credit cards have gone up. Why? Because the big banks are incentivizing the usage of credit cards. Why? Because interchange fees on credit cards are uncapped, but interchange fees on debit cards have been capped by this Durbin Amendment. Interestingly, Max, there is a exemption for the Durbin Amendment. Banks under $10 billion in total assets have uncapped interchange fees on debit cards, and this has been quite a little profitable business for some of these banks. Some of them I'm actually an investor in, so I'm not trying to pump the stock by any means. But Pathward Financial is a company I know quite well, and that is a business where uh, they make money from interchange on debit cards. They are around $6 billion in total size. If they were twice that, their rates would be severely capped, and they would be nowhere near as profitable a business. By some companies of which I'm not an investor in, but I know are also in this business, are a Coastal Community Bank (CCB), as well as GBFH. And Coastal Community Bank is, by the way, this is called BAAS, Banking as a Service. They sometimes, more derogatory, referred to as rent a bank, of basically allowing fintechs that are not banks, the types of companies that are invested in by Silicon Valley and stuff, but they're not banks. Uh, they still need to do bank-like stuff, so they just rent the license and use the license. But the banks that actually are backing them get to benefit by this interchange fee in various ways. And by the way, CCB is the bank that is for the Robinhood credit card. So Robinhood was not a bank. I think they've since applied to be a bank, maybe because the Trump administration is more friendly to banks. So maybe CCB is no longer the massive beneficiary of this. I don't know, but I know at a time they definitely were. Interesting, Max. So you say, okay, if everything is going to go to Europe and there's going to be maybe a cap on interchange fees, or there's this credit card competition act, or credit card interest rates are going to be capped at 10%, then that's going to be horrible for Visa and MasterCard. Sure, okay, maybe. But you look at actually Visa and MasterCard's revenue in the US versus outside of the US. For Visa, I took a look at it, and actually their international revenue exceeds their US revenue. they don't break it out by profitability. So it is possible that the US is the giant profit center. But I have a feeling that Visa and MasterCard are making a ton of money outside the US where the rules are different. And also, Max, I think that if you look at the pricing power, like these things, the banks are going to lobby incredibly heavily against this 10% cap if it happens at all. And I think if the 10% cap actually happens, it would hurt like Capital One massively, Synchrony Financial massively, JPMorgan's credit card segment, which is a lot of its profit. It would hurt that massively as well. I don't know if that would hurt Visa and MasterCard as much. Like in Europe, the fact that interchange is capped is bad for the banks, or it hurts the banks, so they make less profit. But Visa and MasterCard are still doing really well. So I think that the advantage of Visa and MasterCard is that they can scale tremendously and be basically the rails for global finance, at least for consumer spending, and their costs don't scale nearly as much. Whereas JP Morgan and Barclays, like they always have to hire all these people and build out new offices and that kind of stuff. So, I generally, if we have more weakness in Visa and MasterCard, I personally and might view that as an opportunity to as a buying opportunity. But as nothing obviously on the show is investment advice. However, Max, on our previous episode last week, I said we were talking about some basically fake Chinese AI company that has no revenue, and I said I especially am not recommending this stock. I wouldn't say that for Visa and MasterCard. They are quite famous. It's no secret that they're extremely high quality businesses. And in my view, personal view, of course, there's certainly worse places to put money. Any thoughts before I move on to other things within the 10% cap, and in particular, potential beneficiaries?
Yeah, I mean, you mentioned a foreign stock. We just went through this, Jack, you and I, with the
Yeah,
cap on rates for consumer lending in China.
I thought
So
of
we
that.
just saw what can happen to now. These stocks were like pure plays on this consumer lending. JP Morgan, as you said, is a much more diversified business. So perhaps, the precipitous drop that we saw in these stocks going down in many cases, like well over 50% in the Chinese consumer fintech companies. So depending upon the degree to which the lender is reliant on this, if this does happen, it could be serious. Again, our base case not happening. But if you just look at what happened in China, so interesting. The Don is perhaps importing this policy from China and the Communist Party there.
Yeah, he's importing it from the East. He's importing it from the left. The well-known Republicans, Bernie Sanders and AOC, quite left in the Democratic Party, it's fair to say, proposed a 15% cap in 2019. That did not happen. And now a Republican president is proposing a 10% cap. So I think it just goes to show the political landscape has changed, and the president is willing to go very far to achieve his goals of either lowering costs, which he would like, or at least getting an optical win and moving his weight around in the press, regardless of how you want to see it. I also think that I'm sure the Wall Street Journal editorial page and the old school pro business wing that was somewhat associated with the Republican Party, I'm sure they absolutely pilloried and loathed that proposal from Bernie Sanders and AOC in 2019. I think those types of folks, are in a little bit of a tough spot, at least when it comes to the media. So Max, I think that what I proposed about my potential beneficiaries of this, how there are companies that make money on debit interchange below the Durbin cap, like real heads in the who or work at the hedge funds trading the financial stuff, like they know this, but I think within the wider public it is not known at all. Some stuff that is not my own analysis, but is much more widely known in the general investing public, like I've seen on Twitter, is that the buy now pay laters are going to benefit from this. That basically the PayPals of the world, the Klarnas of the world, the Affirms of the world, as well as these subprime lenders, they are going to be lending to the consumers that would have borrowed at 20%, but now they're going to be borrowing at perhaps even higher rates because they no longer can borrow via their credit card. Again, this is if this policy goes through. So, I was hopefully people recognize me as being fair-minded. That despite being an investor in Visa and MasterCard, like I recognize that these policy, the Johnson Credit Card Competition Act that could hurt Visa and MasterCard, that I don't think that the negative consequences would be that big. I do think, Max, not to be a mainstream pro business elitist guy, but like I do think that, yeah, if credit card caps credit card rates were capped at 10%, people who are currently borrowing at 15 or 20% or 25% would not be able to access credit. And even, Max, people who pay off their loans and their credit card balance every single month, but are being lent the credit card access with APRs above 10%, even they might not be able to access that as well, because the credit card lenders, they want the option to make money off revolvers, even if you're not going to actually be a revolver at well. So I don't want to agree too much with like the American Banking Association, but I do think that pushback is generally true, and I think it would push borrowers into the hands of the buy now pay laters, into the hands of the non-bank lenders, into the hands of the subprime consumer lenders, the payday lenders, which are often seen as somewhat engaging in usury of lending at
Cash for
APRs.
gold? We're talking cash for gold here?
Cash for gold of 40%, 50%, 60% APRs, as well as some effective lending that is at interest rates of above 100%, even though you're never going to see something on paper that says 100%. But a company that makes a loan, if they lend you $100, and it's a 1 week loan, and the cost is $5 we're not making a loan, Max. That's not a loan. There's no interest at all. But for a $100 loan, they charge $5 for a $5 fee, 5 times 52 weeks in a year. That's effectively an APR of over 250%. So I think, Max, there are a lot of these fintechs, whether they're publicly traded or they're privately traded and backed by VCs, who talk about democratization of finance and how isn't this so great? There's no interest at all. Like, they are charging interest. It's just they're kind of not calling it interest, and they're calling it fees. And actually, Max, this is something that happened to the Chinese fintechs, and it happens in Asia, in China. Dare I say? I hope I don't offend anyone, but throughout the Middle Eastern world, where there is Sharia finance, there's something called Sharia compliant finance, where it is highly frowned upon within Islam to lend at interest, but the economies within that region, obviously, they need
Find ways.
yeah, they find ways. They make loans that don't have interest. They just have fees, and that makes me think of my interview with the former Silicon Valley Bank CEO, who he was bringing his bank to China, and he said, "Oh, we need to do warrants. Like, this business to make money banking all these technology companies, you need to be able to take warrants in their business." And the Chinese officials and bankers said, "Warrants? Oh my God, that's so capitalist and so non-Chinese, so non-Eastern. We can't do that at all." And then the CEO just described, "Well, they're not warrants. They just think of them as success fees." And then the Chinese bankers, "Oh, success fees. Yeah, we'll do that." So the very similar thing, but sometimes things just have to be worded in a different way for them to become palatable. And my point is that I think if this 10% cap is going to happen, it will cause a huge surge in alternative forms of finance that the true cost may be much, much higher.
All right, Jack, I got one for you. You got my brain going about who are the people that might win, that are gonna get new lenders if this goes through. Easy Corp, EZPW, is a publicly traded pawn shop brand that trades at 15 times earnings. It is up 75% over the last year, 356% over the past 5 years. I mean, if you're just playing the general K-shaped nature of the economy, seems to be doing well, as people in hard times are turning to the oldest lenders in the world, pawn shops. There were points in times in America where pawn loans were the dominant form of consumer finance. So we might be going back to those old days with this type of policy. So
we might, Max. I believe that was a stock that was referenced in a trade idea of Citrini's 26 ideas for 2026. A name that I know was named in the similar theme was the stock Dave. I know it has a horrible name, but it is involved in these very short-term loans that may or may not have on paper interest, but the true APR can be quite high. Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company-specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at Fiscal.AI/MM to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's Fiscal.AI/MM. Let's get back to the interview. All right, Max, we've talked about this.
What about the other interest rates, mortgage rates? That's almost as big, if not bigger news.
Yeah, so this actually happened, and this actually has been happening actually for several months, even going back into 2025. So the president did instruct early in January the GSEs, government-sponsored entities, so Fannie Mae and Freddie Mac, to buy up to $200 billion worth of mortgage-backed securities. And this is a big, big deal because if you buy mortgage-backed securities, you drive mortgage-backed security spreads narrower, and then you lower mortgage rates, and that makes it very affordable. So historically, you think of who is the buyer of mortgage-backed securities in order to ease credit conditions is obviously the Federal Reserve, and that is done through quantitative easing. And so the mortgage-backed securities the Fed bought peaked at 2.7 trillion. It's been doing quantitative tightening, so now it's at a little less than 2.1 trillion. So $200 billion of purchases is definitely nothing to sneeze at. And Max, a lot of the stuff we talked about, like President Trump, he may think he has authority, and his people in the circle may allege that he has this authority, but it's unclear whether he does have this authority. Maybe he doesn't have this authority. But when it comes to the Fannie Mae, that is in the GSEs, completely controlled by the FHFA director, who is appointed by President Trump. And Bill Pulte is a Trump loyalist who is very on board. And not only has Bill Pulte been purchasing mortgage-backed securities for several months, actually, before President Trump made this official announcement in January, he actually has been leading the attack against Fed Chair Jay Powell, which we'll get into later on the show. So President Trump can do this and has been doing this. And Max, if you can put up, we can look at some figures from Fannie Mae. Throughout 2025, Fannie Mae's retained mortgage balances went from 77 billion in 2025 to 123 billion by the end of the year. And then President Trump made the official announcement. Likewise, Freddie Mac's retained portfolio went from around 93 billion in February 2025 to 123 billion by the end of the year. So now combined, they've got about $250 billion. And so their retained portfolio cap, Max, is each $225 billion each, so $450 billion. So there is like a $200 billion gap where Bill Pulte can buy all these mortgages, and it will still be compliant with this law that they have to be below this $225 billion cap for each one, or $450 billion in total. So it's completely allowed by the law, as I understand. It is going to happen. It is happening. It already has been happening throughout, let's say, the last 6 months of 2025, maybe even earlier. So Max, when this policy was announced, the mortgage basis, which is the spread between mortgage-backed securities and treasuries, actually rallied around 13 basis points. And some sources are saying that was the biggest rally in mortgage basis since the day that Silicon Valley Bank failed in 2023, close to 3 years ago. Um, and by the way, one of the sources on that was Harley Bassman, who you recently interviewed. Uh, that was a great interview. Only if you had done that interview, maybe after, it was just slightly out of date. But man, that is the guy to know and to quote. I think, Max, that I had observed that interest rate volatility, implied volatility, had been falling. Obviously, the move index, which Harley Bassman literally created and invented, has been going down. And I always associated that with a fundamental view. Oh, people in the market, people like Harley Bassman who are following mortgage volatility and interest rate volatility and pricing it every single day, that must be a reflection of their view that realized volatility is going to be lower in the future. And of course, that is an aspect. But now I'm just realizing, maybe Trump called Bill Pulte and he's been buying mortgage-backed securities every single month, and that's why the mortgage basis has been going down, and the calculator for implied volatility says that the move index is going to go down. So it's just always two ways to look at it, like fundamental view versus just flows.
Well, that's also part of the reason I think it's like funny that people are so bullish on the recap and release of Fannie and Freddie, right? Not that the person who runs them after they become private companies again couldn't be swayed by the president. It certainly can happen, but it's not quite the direct pick up the phone, call Bill Pulte, tell him you're going to do this or you're fired type of thing. That he has right now. And certainly until interest rates go lower, I don't see why he would give up that direct access to somebody who can achieve one of his policy goals, help him
And
achieve one of his policy goals.
so I actually haven't read these two pieces, but I'm going to. They're on my reading list. One is a piece by Joseph Wang at fedguide.com about the GSEs. The other is Buyback Capital, a great researcher on Substack. He's really in the weeds on the GSEs. So, just like to shout out other people whose work is good. And I haven't read these two pieces, but I'm 100% sure that the work is good, knowing the quality of the researchers. So, Max, you in 2025, a great trade for you was being short the home builders, and in particular, several companies in particular. And that thesis, I'll be honest, I doubted the trade, but I was wrong and you were right. That worked really well. Is How does this affect your view if the president is literally buying hundreds of billions of dollars worth of mortgage-backed securities to lower mortgage rates while he's putting pressure on the Federal Reserve to lower interest rates, which is very connected with mortgage rates? Is that going to be a boost to demand, and is that going to cause a bid for these home building and home associated stocks, which struggled so much throughout last year?
They definitely caught a bid to the point that like I was short again. They had gone down, they bounced back up. I decided to get back in and got stopped out like just this week on my preferred play, which as you know is BLDR, which I like it just because it has a bunch of beta. There's a 3x ETF, which the ticker is nail. And if you look at like BLDR compared to nail, they're not like 100% correlated all the time. There's an interesting play there where there's a new, like they consolidated a lot of companies and just did a lot of roll-ups, and they succeeded in that for basically like a decade. But Brad Jacobs launched his own roll-up company, so now you're competing against a guy like Brad Jacobs. So there's another bidder now for these companies that had no bid. So that's partially why I like BLDR, because it has this idiosyncratic competition aspect to it, but it has a lot of beta to rates, to people's expectations for housing markets, to the point that it trades sometimes with more volatility than the 3x home builder ETF. So it's a great trading sardine. But yeah, it has immediately affected prices. I don't really know. I mean, I will keep watching and seeing if the housing market ticks back up and if transactions tick back up. I don't know what the price is. Look, like cash buyers have been doing what they want to do, right? So I don't that doesn't really affect them. Certainly here in New York, like the joke with real estate agents is like a buyer's not serious unless there's 4 people at the showing. the husband, the wife, and then one of their parents, one of their sets of parents. So, that's
That's
like
good. That's good.
that's the cash buyer. So like you better show up with mom and dad, or else somebody else is going to show up with mom and dad and outbid you. It doesn't matter whether you're pre-approved for what loan. There's going to be a cash offer. And so these people in the market that are borrowing, that aren't in that like wealthy group of people, I don't know where the number is that gets them back into the market. And I certainly don't think, with all the other things that we're hearing about in the K-shaped economy, think that lower half of the K is stepping into the housing market anytime soon. The big news also today was making it easier for people to tap their 401ks to buy homes. I think you can already do it to buy a first home, but you have to pay capital gains tax, but you're not paying that like early withdrawal fee. So I think they're actively working on some 401k related um some 401k related thing. I don't know whether it's going to be you're able to take the money out with no tax, whether it's going to be for people who are not buying their first home, or some combination of all of that. But they are pulling out all of the stops. So if I was short somebody who was inclined to short housing, I would wait. There's just like a lot of wait till they throw everything they possibly can at it before getting back in. But I'm out of that trade for now.
Yep, Max. One particular part, I don't know if I like it the most, or it's just a very smart part, a very nuanced part. But is your point about now BLDR as a roll-up play has more competition? Warren Buffett has spoken about that. How in the 1980s, 1990s, 2000s, he and Charlie Munger were using all their cash they generated to buy all of these private companies, and often at quite cheap valuations. However, with the rise of private equity, now all of these Wall Street gunslingers were going to all the endowments, all of the high net worth individuals, all the foundations, raising all this money and buying the company. So there's just so much more competition. And therefore, like Charlie Munger and Warren Buffett themselves predicted, oh yeah, what we did in the past, we're not going to be able to do in the future. I think I don't follow him nearly as closely, but the now retired Mark Leonard of Constellation Software, also legendary for being a tremendous, incredibly accomplished capital allocator, has said the same thing, that all these private equity companies, they used to be buying steel mills and greeting card companies. Like now they're buying software businesses, and now Constellation Software has a lot of competition, even in that like lower middle market company that has a very small EBITDA number. So yeah, when competition increases, historically excellent returns are less likely to continue. So I think that's true. I will say, Max, I have been, in my own personal view, I don't really have any trading outlook or position on the home builders, but I do think that there is a shortage of housing in the US and globally that is secular. And I have a reasonably high conviction view that the reason home prices are high is because they're in the US is because there aren't enough homes, not because there's been a credit bubble. Like I just look at the delinquency rates of mortgages, and the best performing asset in terms of credit quality is a mortgage to someone with a pulse in the United States. And it's just the complete opposite of the subprime bubble from 2001 to 2011.
Jack, but
Yeah.
that kind of reminds me of when Elon was like, well, there's unlimited demand for Teslas. Like, yeah, there's unlimited demand for Lamborghinis. There's unlimited demand for 3-bedroom apartments in New York City where there's more jobs. And it's not just one great company. Like, look, I'm from Cincinnati. We've got Procter and Gamble. We've got Kroger. There are these great companies there. But guess what? If you leave Procter and Gamble, there's not another shop that is in the consumer goods business across the street that you get to go work for. You got to go somewhere else. New York City, Los Angeles, Chicago, places, increasingly not Chicago, but places like this, there's competition. There's always going to be demand for housing there. It doesn't matter how much you build. It's just going to make it more affordable for people to move in here, and then suddenly we're going to be in the shortage. So I've never, as much as I do buy the like housing shortage narrative somewhat, I am just like skeptical of these goods that in theory they have unlimited demand. Everybody wants a house. Of course, there's a shortage. And so, you know, yeah, and they're going to they Trump has said himself, he has said housing prices, he doesn't want to bring them down. He does not want to bring down
Yeah.
housing prices. He is not going to do that. It is the greatest source of wealth for the majority of older Americans, and he doesn't want to do that. The prices need to come down. The prices need to come down, and they're not going to. And that's I just don't
So
get
why
it.
short housing? Max, you very cogently over the past 150 seconds or so have
I'm not
made an
short
argument.
home prices. I
Yeah,
am
yeah.
short the builders of houses that are trying to sell houses at a price that that is not the market will not clear.
And so you think, yeah, you're just a secular, you're just a bear on housing volumes. You think
Yep.
yeah,
Yep,
yeah,
just a volume bear. The prices are not gonna go
yeah.
down. The boomers are not going to downsize. I mean, eventually they're gonna die. But it's just not it's not happening. And then also just the idea of like what all of this nostalgia about when you could buy a house on the GI Bill. Like, have you, especially for people who live in urban areas, if you've never like driven around some of these like older suburbs, or they're they're technically within the city, like they're not suburban, but like it's just not you can buy a house in deep Queens. Like you can do it. It's affordable to buy a house in deep Queens, and that's what a house looked like in 1952 in the late 40s. People just don't want it. They don't want
Mhm.
that house. That's not what they're being sold on Instagram. It's not what they're being sold as the aspirational idea of homeownership. And so, uh, you know, there's not a shortage of fixer uppers in Queens.
Mhm. Yeah, I guess the question is, what's the ratio within the Case-Shiller index within the entire thing between houses for which the demand is truly unlimited, as well as you said, that the fixer upper in Queens. An interesting paper, Max, that I actually just randomly happened to go through again like a week or two ago is called "No Price Like Home: Global House Prices 1870 to 2012," and there is a trend that maybe some people will be familiar with, of just like from 1870 to maybe 1950 or 60, home prices actually were remarkably stable in real terms, and in some instances went down. And by the way, this paper goes through like the vast majority of countries for which there is data. So Australia, Japan, most European countries, the US. And basically I asked Gemini, and basically I asked, why is this the case? I think people, maybe people with maybe a more like left wing view would say, oh well, it's because housing has become commoditized by the bankers and the greedy home builders. And okay, like that's an argument, but maybe there's an aspect there, but another argument like that's at the fundamentals, according to what I asked Gemini, is the fact that like from 1870 to 1950, there was not a shortage of land at all. And so basically all you had to do was move to the other town where land was really cheap and create a new town. Um, Charlie Munger talked about how his grandfather in the 19th century uh, first came to Omaha and basically helped create the town of Omaha. Or maybe it was his great grandfather. I don't know, but he did say that. And th- that obviously can't happen in the US anymore, or really anywhere. Like there aren't that many more lands that are going for very cheap. And in particular, the real secular trend from 1870 to 1950 was transportation. So the fact that as everything got more connected, you could live further and further away. And so there's more places, but now that's not really going to happen
And
anymore. So
we're kind of getting away from the housing thesis that we were talking about. But yeah, I'm just like
yeah,
structurally a bear on housing volumes overall because of all
you're
of these forces.
well, it's good you're precise. You're a bear on housing volumes, not housing prices. I'd agree that I'm also not a bear on housing prices, and I'm not predicting some extreme price surge. I hope we don't get that. I will say that just looking at the pace, no price like home it's interesting. Some Americans may be like, well, in America, because our economy sucks, we're so greedy, whatever, we have this housing bubble and housing is a commodity. But in the rest of the world, it's better. This paper will disabuse you of that notion. If the surge in real estate prices over the past 50 to 90 years, is much more extreme in Australia, in Canada, some European countries, in China. Really, I think over the past 30 years, the only country the only large country where real estate prices moderated and actually went down in real terms, I believe is Japan. Max, tell us about what President Trump has been doing with the defense sector.
Yeah, it's another sector where he has stuck his nose under the tent, and specifically, he threatened with an executive order to um, basically withhold contracts from some of the big defense contractors. He even posted specifically about Raytheon, said that they're one of the worst companies to work with, and he threatened to withhold contracts for CEOs that don't deliver on time. He mentioned Boeing, said something about how it took 5 years for our allies in India to get helicopters that they ordered, and how ridiculous that was. So he's not happy with the credit card companies. He is not happy with the defense companies. And the interesting thing is, as you said, some of these credit card companies exposed potentially to this shift, sold off, and you view that as a buying opportunity. If
The
you were
payment stocks, Visa and MasterCard, to be clear. Yeah.
Yeah, the payment stocks sold off. And if you were to have tried to do that with the defense companies, you had one day. You had one day. So he put out this executive order on the 7th. Um, and so I believe they sold off that day, and they're already up. They're already up on the year. If you look at the ETF, if you look at RTX, the parent company of Raytheon, they're
Because why, Max? Because why?
well, he did announce that he wants to raise the budget. So they're going to have to spend the extra $500 billion somehow. Um, but it's just interesting that just because Trump has decided to target an industry, even individual companies, um, you know, the market kind of susses out, well, the money's got to go somewhere. And, tying it back into credit cards, like, this is a consumer economy that's driven by credit. I really don't know how we're gonna upend that. So I just thought that was interesting. And one of the other things he said was limiting CEO pay to $5 million. Um,
For defense companies.
yeah, for defense companies. I'm not necessarily, I think legislatively that would be extremely difficult, but these companies are paid by government contracts. So if we talk about like what are the levers that he has to pull, and he's the commander in chief. So the executive branch does kind of decide these things, how the money gets allocated. We're going to talk a little bit about Jerome Powell and the Fed, and specifically the issue he has with the testimony he gave related to the over $2 billion renovation there. We're talking about the Pentagon here that has failed, I think, an audit for
Yeah, I
over a
mean,
decade now, and there's
it's
billions and billions of
ridiculous.
dollars missing. I don't see him. I don't see him investigating any of the past, heads of the Joint Chiefs of Staff or generals or any of the people in the purchasing department at the Pentagon who would be responsible for this. So, kind of segueing into that topic of Jerome Powell and what's been happening in this Fed drama, um, you know, he came out and he said pretty clearly that he believes that this is a political move because he is not lowering interest rates. And I think if you look at certainly some of the other areas of fraud and waste in government, this $2.5 billion renovation of the Federal Reserve is certainly not the lowest hanging fruit.
Yes, I'll get into Powell in a sec. I just want to share my own opinion. I think what the president has proposed on defense, like I don't think it is ridiculous, and I think what is ridiculous is a company making billions and billions and billions of dollars of selling technology to the government that is never going to be used. Very, very unlikely to be used, and just basically, having a 30 to 40% profit margin off of that. I think I'm not a lawyer, but I think that that policy is I don't think the president is wildly off base. That's my own personal opinion. I think the broad point, Max, is the president is at least announcing policies that are a big deal, that are in some instances very anti-free market, that are going to achieve his goals, which are goals we can probably all agree with in many instances. And they don't go with convention. The question is to what extent he's going to follow through or be able to do this. I think, Max, on the tariff front, the president was a little bit of the Charlie Brown thing. He was holding the football, and I fell for it. Many investors fell for it, and the announced tariff rates of 30, 40 for a few days on China, 100 and some percent on China. That didn't happen, and we now are in a mid-teen tariff rate, and the president definitely moderated his views, and so basically you can call the president's negotiation strategy. Shoot for the stars, land on the moon. So maybe there will be moderation with the president's policies as well in this instance. We don't know. Do you have any sort of inkling, Max? Like, is the president for real, or which President Trump, when it comes to credit cards, when it comes to these defense companies, other policies, which President Trump are we going to see? Are we going to see the president who moderated tariff policy and did rollover, and then kind of somewhat back down, or are we going to see the president who just sent the military and abducted the effective leader of Venezuela?
I think it all depends on how they act and how they treat Trump. I mean, I think he just wants to be treated like he's the president, like he's the most important person in the world. And if you do that and you kind of play ball, it's going to work out. I mean, look at Intel. Instead of Intel saying, "Oh, we're a private company, we don't want to do that," they said, "Yeah, sure. Like, let's take a stake in Intel and look at the returns that Intel has had." That's just what he wants. So if you are going to push back, right? Like you talked about the Trump card, like announcing a Trump 10% interest rate card, and then like he just wants that to happen so that he can say, "I did this and I get the wins." I don't think he necessarily cares if they deny everybody who applies for it, right? And so it depends.
Or better yet, a Trump card with 0% rates.
Yeah, 0% interest rate that nobody gets.
0% rates that only 1,000 people can use. Yeah.
As I said, I think this is about the midterms. I think I think it's the Mamdani affordability playbook, and promising things as well that you don't necessarily have the ability to enforce or do, and this just works. And that's part of the reason, like housing, we talked about housing affordability as maybe being like the most important thing, and he's going for all of these other things that, yes, they are important, and there are plenty of people out there who are struggling with credit card debt, but as you said, like there's a quote unquote housing shortage. But Trump has said, "I'm not taking prices down. I'm not doing it. I'm not going after the retirees and the people who have built up all this home equity that is all the wealth in America. I'm not doing it because that would actually have consequences." And so I don't think taking away the punch bowl for the consumer is good for what Trump wants, to have the hottest economy ever. I don't think, the defense companies are. I am talking to two friends right now who are both looking for jobs, and one works in data science and is having a very hard time finding a job. The other works in specialty metals and alloys for aerospace and defense, and he's got 7 or 8 interviews. Okay. I don't think that one of the great parts of the economy, when we're hearing about struggles in the labor market, I don't think that that's where the buck is going to stop.
So, Max, you talked about pricing and affordability pressures. The inflation data, CPI, came out today, actually pretty good. So the inflation has averaged 0.13 over the past 3 months. And that is actually well below, if you analyze it, well below the Fed's 2% target. So it appears that inflation is, we don't have enough data to say it's under control, but it appears to be heading in the right direction. And actually, core inflation, which year over year was 2.6, but on a 3 month basis is actually lower. Core inflation is actually lower than headline inflation, which was interesting to me. But yeah, Max, let's get into the much promised story of Trump and Trump's allies going after Jay Powell. Last week, Jay Powell announced that he was on Friday, I believe, shared documents. He was subpoenaed that may lead to an indictment, alleging that when he testified to Congress last year, he lied, specifically about the Federal Reserve's renovation, that it would cost X and it actually would cost Y, and that there were material misstatements. And Powell came out and said, "Look, I'm not stepping down. I'm not above the law, but I'm here to serve the America and the American people." And basically, that what the president is doing and what the president's allies are doing is a pretext. And this is it. Look, I have looked into, but I'm not an expert on the specific all of the claims that Pirro has made, that Pulte has made, that Powell has made, what was true, what was false. It appears that, but here's what I do think, Max, is that even if what Powell's critics say is true, I I don't think that is why they're going after him. They're going after him because President Trump thinks Jay Powell has been too slow to cut interest rates. He's called him Mr. Too Late Powell many, many times. So I do agree. I'm not going to come out on either side on many issues on this particular problem, but I will agree with Powell that it is a pretext. The allegations against him, whether they're true or not, are a pretext to remove him, not because of the allegations, but because President Trump wants a super dove in there and he wants to lower interest rates, to help America, but in particular to stimulate America maybe before this election. That's my view.
Yeah, Jack, I certainly echo your view that that's what it seems like to me. And I don't necessarily know what the allegations are. It is perjury related. So it's about his testimony and what he said. These are not allegations that he's got buddies in DC who are contractors who are doing the electrical and they're getting overpaid and he's getting a kickback or anything like that. He's an extremely wealthy person. I don't think it has anything to do with that. That would be like really serious fraud. And I would be all for investigating that type of thing. This is about testimony to Congress. Not that perjury is a crime that should be taken lightly, but it does seem out of character for Powell to perjure himself in Congress over something as trivial, really, as a renovation. And maybe it doesn't sound trivial, people, to talk about $2.5 billion. But I think that these renovations predate him. These renovations predate Powell. He didn't choose for them to happen. He didn't approve them. They're all, the budget is approved by Congress. So I don't think that this is something particularly dastardly from him. So that's all I got, Jack. Anything for you?
Yeah. So as I referenced at the beginning, JPMorgan did release its earnings today, and I, you know, I think the reason the stock was down, a lot of it was because the credit card things that we've already talked about. But what stuck out to me, Max, was the loan increase. So loans went up 10.8%, nearly 11% year over year, and loans are growing at JP Morgan faster than they grew in 2024, and faster than they grew in 2023. So I think that this whole narrative of the economy is going to slow down and we're going to have a recession and banks are going to pull back on credit, not only is it not happening, it's actually reversing. Looking at the credit losses, what I really paid attention to, which is I think the far most important thing for the consumer, for the economy, is consumer delinquency rates on their credit cards, and that was stable as it has been over several years now. They did guide to a higher net charge-off rate in 2026. Interestingly, maybe this is why the stock was down. I don't know. Their guidance on expenses in 2026 appeared quite high. JB Diamond, CEO, on the earnings call said, "You just got to trust me. We're going to invest, and we want to stay ahead of the competition. And the last thing I want to do is save money and pinch some pennies here and offer lower expense guidance. And then in 10 years, people ask, why did JPMorgan fall behind? So I think if any bank CEO has earned the trust to invest a little bit of money and have some higher expenses, it would be Jamie Dimon. Also, Max, looking at the credit losses, they superficially appeared to spike at a very high credit loss of 4.65 billion for the quarter, which was much higher than last year's number for the fourth quarter of 2.6 billion. So that appears to be an 80% year over year increase. Boom, we have a credit doom incoming, right? Well, not so fast, because actually 2.2 billion of that was just assuming Apple's loans for the Apple credit card program. Apple had been a partner with Goldman Sachs, but that partnership has now ended, and JP Morgan has replaced that. So if you take out that assumption of basically taking the credit losses early before they happen, which is how it happens for bank accounting and credit accounting, taking out perhaps a more accurate figure would be 2.45 billion. So actually a year over year decline in credit quality. So overall, on the consumer side and the consumer and commercial bank, things appear pretty good. I think there were some stumbles in the investment banking, both on the maybe the trading side, but in particular in investment banking. On the deal didn't close in time, and so it wasn't booked in that quarter. But I think if the stock market continues to do well, JP Morgan investment banking and trading will do well. That's generally a rule. Max, I do want to close. Leave some people here with just some thoughts on momentum as well as a particular sector of the market. So earlier we talked about Visa and MasterCard. That is a segment, not just the payment stocks, but I'd say high quality financials. So your S&Ps, your Moody's, your CBOEs, your CME, Chicago Mercantile Exchange, like generally non-bank, non-asset management financial companies that are networks and generally have very high profit margins. And even though the fact that they've existed for a long time, grow at high single digit or low double digit yields, these are the type of companies, Max, and obviously I'm generalizing, that during the bubbles of 2021 traded at 50 or even 60, 70 times earnings. And basically since then, the S&P has outperformed many of these stocks, and these stocks still trade at a modest premium of price to earnings. So now they're at 30 times earnings relative to the market of, I don't know, 23 or 23, let's say. But I think, in my view, their quality advantages and the fact that they have such dominant business model might merit that valuation. So, I certainly wouldn't have encouraged people to load up the boat and buy MSCI when it was trading at 70 times earnings in 2021. But if you just look at a relative valuation, those types of companies might be more attractive, and that is just my kind of view. However, Max, I also want to talk about the importance of momentum, because let's say I want to go long software stocks and I want to go long these high quality financials. Both of them are in a kind of a relative bear market, and I think in particular software stocks are going down every day. In the S&P today, on Tuesday, January 13th, I believe the stock that went down the most in the S&P was Salesforce CRM. I didn't track it that closely, but I believe because an AI company posted some software and released some software that competes with it. So basically, the dominant narrative in the market, and I want your view on this, Max, just the general principle. The dominant view in the market is AI is going to crush these software stocks and these companies that had gross margins of 70, 80% that could just grow so much and make so much money. They no longer deserve a price to sales of 20 times or a price to earnings of 70 times. And every day we should sell those stocks, and we should buy AI stocks, and in particular, like Korean stocks that make memory, like SK Hynix or Micron. That is just what the market is thinking. So, Max, even if let's say I have this view, and I don't know if I have this view, it's not that well held, but like that long term, take a contrarian bet to go long those software names. I just want to introduce that for a long-term investor, by all means, take that view. But like if you're a trader, either someone who is working at a hedge fund and you're an institutional investor who you could be fired if you underperform for several months or quarters, or if you're just a leverage trader or trading by yourself and you have very high in your personal portfolio, very high standards for a Sharpe ratio, and you don't want to handle that much drawdown or handle that much volatility, like I would not advise that at all. And I just want to introduce that concept to you, Max, because I think in both of our investing, we kind of talk about this, and we talk about this personally, all the time.
Yeah, I mean, it's certainly something that it's not in the list of stocks that you talked about, but I own a high quality insurer that has done very, very well. Is generally considered to be, if you look at its historical beta, is less than 0.5, and it was down over 5% today. In the insurance sector, and so something. And I looked all over trying to figure out why is the stock down. I couldn't find anything in terms of news, in terms of research, that really explained it. And when that happens, you just kind of have to say, well, the momentum is going against me here, and seriously consider. Depending upon what your purpose is, what is the purpose of this? Is it a trade? Is it an investment? And then also, is it truly as high quality as I think it is?
Yes, I think that I, Costco is now trading at a much cheaper multiple, but Costco is a great company, whatever. I'll take Charlie Munger's word for it. I never really understood it, to be honest, but like at a 70 times multiple, you better be growing your earnings a heck of a lot, in my view, to merit a 70 times earnings. And also, Warren Buffett is completely right about you shouldn't pay attention to charts and technical analysts and stuff as a long-term investor. And I think generally people should be long-term investors. But like if you're in the game of trading, you should be aware that like what happened on Monday is slightly more likely to happen on Tuesday than the opposite. And that certainly is happening for memory stocks outperforming software. That certainly is happening for high quality financial stocks underperforming, for quality stocks underperforming, for silver and gold stocks doing well. So we'll leave it there. Max, we have really getting into the swing of things on here on Monetary Matters. Our viewers now will be familiar that you are hosting Monetary Matters as well. The occasional episode you've hosted Harley Bassman talking about mortgage volatility and rates. You talked Michael Cowell talking about Venezuela and oil. I will be back in the seat. I've interviewed Michael Power about how Chinese AI could pop what might be a US AI bubble. People definitely should check that out. I also interviewed an expert's expert on the topic of the Chinese economy. He is a professor whose book is the standard reference on the Chinese economy. Whether you're an undergraduate, whether you're in a PhD program, or whether you're in the corporate sector. So people are not going to want to miss that. Thank you, everyone, for watching. Until next time. Thanks for listening. Looking to check out Fiscal AI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.AI/MM.